Hello, beautiful minds, and welcome back to Boni's Life, the channel where we navigate the beautiful, chaotic, and often downright baffling world of cryptocurrency with our intellect intact and our sense of humor hopefully still operational. This week, the market has been less of a raging bull or a ferocious bear and more of a contemplative capybara, just sitting there, soaking in the hot springs of a post-crash consolidation, leaving us all to wonder, is it about to relax or is it about to leap? We've just come through one of the most volatile periods in recent memory. We saw Bitcoin kiss a new all-time high of over $126,000 on October 6th, only to watch the market shed a staggering $600 billion in value after a dramatic flash crash on October 13th that sent liquidations soaring to $19 billion. But like a seasoned prize fighter, the market has picked itself up from the canvas. Bitcoin has clawed its way back from a low of around $103,500 to its current perch at a much more respectable $111,798. So now what's next? Is this the quiet before a storm or the calm after one? Over the next few minutes, we're going to dissect it all. We'll perform a technical autopsy on the week that was, gaze into our crystal ball, which is really just a screen full of charts to analyze the week ahead. And most importantly, I'll give you a full suite of trading strategies, from the conservative to the certifiably courageous. Let's get to it. All right, let's put on our technical analyst hats. If you look at the charts for the past week, the word that comes to mind is indecision. Bitcoin has been trading within a very defined channel, roughly between $107,000 on the floor and $114,000 on the ceiling. Think of it as a market-wide staring contest. Between the bulls and the bears, neither side wants to blink first. The recovery from the mid-October lows has been characterized by what we call cautious accumulation. We're seeing significant support being defended in that $107,000 to $109,000 zone. The volume pattern suggests that the big money players, the institutions, were stepping in and buying the dips. We can see this reflected in the Bitcoin ETF inflows, which after a brief scare with a $936 million outflow on October 22nd, have returned to positive territory, with over 1,000 BTC being added in just 2 days. Technically speaking, our indicators are starting to look a bit more optimistic. The relative strength index, or RSI, has climbed from I've fallen and I can't get up territory back to a healthy neutral bullish 57.9. The MACD, another key momentum indicator, has crossed into positive territory, which is like seeing the first green shoots after a long winter. It suggests bullish momentum is quietly building under the surface. Now, let's talk about our sophisticated sibling Ethereum. ETH has been showing what we call relative strength, currently trading at a robust $3,954. It's up about 1.7% over the week and seems to be buoyed by the excitement around its upcoming Saka Hard Fork. There's a palpable sense of anticipation, with some analysts like Benjamin Cowen suggesting we might see a final rally toward new all-time highs before a potential correction in 2026. The ETH/BTC ratio has also been improving, hinting that some capital is flowing from Bitcoin into Ethereum as traders position themselves for this upgrade. The broader altcoin market is still a mixed bag. The altcoin season index is sitting at a neutral 39, which means we're not quite in that explosive phase where everything goes up. However, we are seeing pockets of strength in layer ones like Solana and AI-related crypto projects. It's a stock picker's market, or in our case, a coin picker's market. And what about the derivatives market? It's the closest thing we have to reading the collective mind of traders. Open interest is up, which is a good sign of renewed confidence. But the funding rates tell a tale of two cities. Bitcoin's funding is slightly negative, suggesting a bit of bearish caution, while Ethereum's is positive, showing more bullish conviction. The overall long-short ratio is almost perfectly balanced at 49.67% to 50.33%. The market is holding its breath. Now, looking ahead, this is not a week to be on autopilot. We have a minefield of macroeconomic data releases that could send shockwaves through all risk assets, including our beloved crypto. The market is a complex beast, and it doesn't live in a vacuum. On Monday, we'll be watching Germany's IFO Business Climate Index and US durable goods orders. These are key health indicators for the European and American economies. Think of them as a checkup for the world's economic engines. Tuesday is the big one for the US, the CB Consumer Confidence Report. This number tells us how the average person is feeling about the economy. If confidence is high, people spend more. If it's low, they save. This has a direct impact on market liquidity and risk appetite. The consensus is for a reading of 94.2, so any significant deviation will move the markets. Then, on Wednesday, all eyes turn to Australia for their latest inflation data. Now, why should a crypto trader in another part of the world care about Australian inflation? Because central banks globally are watching each other. A high inflation reading in a major economy could pressure other central banks to maintain a hawkish stance, which is generally bad for risk assets. The consensus is for a 2.3% year-over-year reading. On the crypto-native front, the main event is the continued preparation for Ethereum's Saka Hard Fork. As we get closer, expect volatility in ETH and its ecosystem tokens to pick up. We'll also be keeping a close eye on those Bitcoin ETF flows. Consistent inflows are crucial to support the price in this range. So what are the big brains saying? The institutional view is getting increasingly interesting. JP Morgan, once a crypto skeptic, is now allowing institutional clients to use Bitcoin and Ether as collateral. This is a massive step in legitimizing digital assets. They also released a report suggesting stablecoins could drive $1.4 trillion in new demand by 2027. That's not small change. Goldman Sachs is adding to the long-term bullish case, forecasting a series of Fed rate cuts in 2025 and 2026. Lower interest rates generally make non-yielding assets like Bitcoin more attractive. And the ever-bullish Cathie Wood of ARK Invest has reiterated her aggressive price target of $2.4 million for Bitcoin by 2030. Even Michael Saylor, a man who has seemingly never had a bearish thought about Bitcoin, continues his optimistic pronouncements, predicting Bitcoin will outperform the S&P 500 for decades. However, we must temper this optimism with a dose of reality. Bloomberg's analysis of the recent crash highlighted that Bitcoin failed to act as a safe haven asset, a digital gold. When global markets panicked, Bitcoin panicked right along with them. This is a crucial reminder that in a true risk-off event, all correlations tend to go to 1. Alright, this is the part you've been waiting for. We've analyzed the past and peered into the future. Now, how do we trade it? I'm going to lay out 5 distinct strategies catering to every risk appetite, from the cautious kitten to the roaring lion. And remember, these are not financial advice, but educational frameworks to help you think like a professional trader. Strategy 1. The Range Rover, conservative. This is for the trader who likes to play the percentages. Given the well-defined range of $107,000 to $114,000, a mean reversion strategy is the logical choice. You'd look to enter long positions near the bottom of the range, say between $107,500 and $108,500, and take profit as the price moves back toward the middle or top of the range. Conversely, you could initiate short positions near the top, around $113,000 to $114,000. The key here is strict risk management. Your stop loss on a long position should be just below the range support, perhaps at $106,500. This is a low-leverage, high-probability strategy for a sideways market. Strategy 2. The breakout artist, moderate. Consolidation patterns don't last forever. This strategy is for those who want to catch the next big move. You'll be watching for a decisive breakout. For a bullish breakout, you're looking for a strong move above $114,100, confirmed by a significant spike in volume. A 4-hour candle close above that level would be your entry signal, with an initial target of $115,800. For a bearish breakdown, you're watching for a break below $111,000, again with high volume, targeting the $109,000 and then $107,000 levels. This strategy carries more risk, as false breakouts or fake-outs are common. Volume is your best friend here. Strategy 3. The news trader, advanced. This is for the adrenaline junkies who thrive on volatility. You'll be trading around the major economic data releases I mentioned earlier. For example, if the US consumer confidence number on Tuesday comes in significantly higher than expected, you could look to enter a quick long position on Bitcoin, anticipating a risk-on move. The key is to wait for the initial chaotic spike to settle, usually within the first 15 to 30 minutes, and then trade in the direction of the established trend. This requires focus, discipline, and the ability to make decisions under pressure. It is not for the faint of heart. Strategy 4. The Zen Master, DCA, long-term. This isn't really a trading strategy, but an investment philosophy. It's for the long-term believer. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of the price. For example, you might buy $500 worth of Bitcoin and Ethereum every single Friday. This removes emotion and the impossible task of timing the market. For those who want to be a bit more sophisticated, you can implement an enhanced DCA, increasing your buy amount when the market is fearful, like when the RSI is low, and reducing it when the market is greedy. This is the most stress-free way to build a long-term position. Strategy 5. The altcoin surfer, aggressive. This is the high-risk, high-reward play. With Bitcoin's dominance showing signs of waning, a new altcoin season could be on the horizon. This strategy involves rotating capital into promising altcoins that might outperform Bitcoin in the short term. You'd be looking at sectors showing relative strength, like Layer 1s and AI tokens, and of course the Ethereum ecosystem ahead of its upgrade. This requires active management, a deep understanding of token fundamentals, and the discipline to take profits. It's about catching the right wave and getting off before it crashes. No matter which strategy you choose, risk management is paramount. Never risk more than 1 to 2% of your portfolio on a single trade. Always use a stop loss, and be prepared to sit on the sidelines in cash if the market is unclear. The goal is not to be right every time. It's to stay in the game long enough to be profitable over time. So there you have it. The market is at a fascinating crossroads. We have a technical picture of consolidation, a fundamental backdrop that remains surprisingly bullish, and a week ahead packed with potential catalysts. Whether you're a Range Rover, a breakout artist, or a Zen master, there's a path forward. And remember, the market is a reflection of human psychology in all its fearful and greedy glory. Our job is to observe, analyze, and act with discipline. It's an intellectual game of high-stakes chess, and that's why we love it. What are your thoughts on the week ahead? Which strategy are you leaning towards? Let me know in the comments below. And if you found this analysis valuable, do me a favor and hit that like button. Subscribe to Boni's Life and ring that notification bell so you never miss an episode. Until next time, trade smart, stay curious, and I'll see you in the next one.